please enter your queries in the Q&A box, and we'll try to get to them during the panel or at the end if there's time. This webinar is also eligible for SFD CPT hours, subject to employer approval. To claim your CPT certificate, please complete the survey at the end of this webinar. Today's webinar is organized by HKGFA's Asset Owners, Asset Managers workstream under the Sustainability-Related Disclosure, Policy and Standards Working Group. It comes at an important and relevant time as banks are now developing their own net zero transition plans, and the HKMA itself will be incorporating a transition focus into the next phase of the Hong Kong taxonomy. With the sell side and regulators well and truly preparing themselves for the transition, how is the buy side thinking about net zero transition, and what does this mean for asset owners and managers? To answer some of these questions and to explore in further detail, we have a fantastic panel of speakers from the investment world to share with us their insights. To lead this discussion is none other than Hong Chiu, Managing Director, Chairman and Chief Executive of Lazard Greater China, and lead of the Asset Owners, Asset Managers workstream. Hong, over to you.
Thank you, Tim. Good afternoon. My favorite panelists and attendees joining us from around the globe. Welcome to the webinar. My name is Hong Chiu. As Tim introduced, I'm the moderator of today's discussion, Chairman and CEO of Lazard Greater China, an independent global investment bank for financial advisory. We're gathered here at a very important moment in finance. As banks and regulators begin to carve out their path toward transition finance, there lies a broader opportunity for the entire business and financial community to take a proactive stance. Today, we aim to dissect the sectors and activities that beckon the attention of the investors. Before we delve into the discussion, let me introduce to you our esteemed panelists, each bringing a wealth of knowledge and experience to today's conversation. Alex Chen, Head of ESG Asia Pacific at Invesco. Alex is at the forefront of developing ESG and impact environment capabilities, contributing significantly to ESG strategies and initiatives in this region. Swami Venkataraman, Sustainable Finance Global Head of Assessment at Moody's Ratings. Swami leads a global team in producing a pivotal assessment and research on sustainability. Hideki Suzuki, Senior Director of Sustainable Investment at Manulife Investment Management. Hideki leads the ESG data and methodology development projects. Maggie Ye, Managing Director at Neo Capital. Maggie is instrumental in leading Neo Capital's US dollar investor relations, sustainability strategy, and portfolio management. Our panel today is uniquely positioned to explore the details of transition investing, from identifying the sector ripe for sustainable investment to navigating the evolving landscape of ESG framework. So as we proceed, I encourage our audience to engage with our panelists, bringing in your questions and insights to what I hope will be a very enlightening discussion. So now let's dive into our discussion. The first question, can each of the panelists please help define what is the transition investing to you and your organization? Starting from Alex.
Yeah, thank you, Hong. Thank you, HKGFA, for the invitation organization Hong, I think you asked an excellent question to start with, and this is probably a million-dollar question because it's hardest to define what transition investing, and it's precisely one of the challenges with this fast-growing space today. If we were to think about transition, simply put, we would define transition really as a global shift from brown sectors to green sectors, and this can be driven by energy security or economy-wide decarbonization targets. So transition investing, simply put, is as sectors transition from brown to green, what are the kind of risk and opportunities that we see in the sector? So that would be sort of the simplest way we define it.
Thank you. And that's actually a great place for me to start off as well. So the way we think about it, ultimately, as sectors transition from brown to green, we want to see what opinions can Moody's provide that would help investors in their decision making. And so we provide two kinds of products. One is more straightforward, where we opine on the sustainability characteristics of a specific piece of debt or a framework, like the green bonds and sustainability linked bonds that people are familiar with. And maybe we will see eventually transition bonds if we can agree on a definition. But even in the absence of these definitions, the other product that we have, which we think is relevant to the market, is to simply answer the question, notwithstanding a particular piece of debt, is this company going to transition from brown to green? How ambitious are their targets, and how credible are their plans to go from brown to green? And that assessment, that view of the company as a whole, can help inform investor decision making. So that's sort of how we look at transition. How can we help investors decide whether a company is going to be successful, or rather how successful companies are going to be in meeting targets that they have stated publicly?
Thank you, Swami. Hideki?
Thank you so much, Hon. So in terms of the definition of transition, like Alex mentioned, it's a very difficult one, and especially us, those of us located in Asia. So the regional context, idiosyncrasies, those things drive differences in what transition means. So for example, in terms of electric vehicles, should we be talking about passenger EVs? Let's say in the Philippines, where the car ownership is the lowest among all the Asian countries, whereas other countries like Malaysia, the car ownership is over 70%. So in terms of transition, what should we be kind of looking at and then talking about? It differs significantly based on the regions within Asia. That said, in terms of the transition to us, it means transformative actions that have an end. Transition is a necessity for many businesses, but it has to have a sunset. We cannot be transitioning forever, given what the science tells us on the consequences of the climate change. So we say climate change is a long-term risk, but when you think about it, 2030 is really around the corner, which is the year many set as the midpoint to achieving net zero 2050. So as investors, we need to keep reminding ourselves and then also investee companies to have a sense of urgency. And there are many ways to gauge that sense of urgency from the investee companies, but that is probably for the later discussion.
Thank you, Hideki. Maggie.
Hi, everyone. This is Maggie from Neo Capital. So first, probably a little bit words about Neo Capital. We are a private equity firm established in 2016 and with a total AUM of around $2 billion USD. And it's very interesting to hear other panelists sharing their thinking about transition investing. So back to Neo Capital to answer this question. We focus on two mega industry. One is new mobility, another is new energy. And what we see is fundamental changes are undergoing in those two industries. If you look at new mobility, it starts with smart EV. For those who recently traveled to mainland China, you will see how prevalent EV is nowadays on the street. And just last month, the penetration rate of new energy vehicles in mainland China just exceeded 50%. That means in the global largest new car sales market, electric vehicle is right now the majority rather than traditional ICE vehicles. And if you calculate the lifetime carbon emission of a EV, it is definitely much lower than the ICE cars. I would like to point out that EV is much more than just powertrain. It's a brand new way regarding how the car is designed, how people use their cars. So that is very big transformation undergoing right now. And the development of electric vehicle will naturally be connected to the new energy. We see the fast development of EV and the rapid uptake of alternative energy, especially solar, are bringing new challenges to the grid because all those energy resources, we call it distributed energy resources. Therefore, they will need the grid to be more flexible to interact with those kind of new energy resources. Therefore, new technologies, new business models, as well as new players are actually required to join the game, to join the ecosystem, to help the grid to transform, to adapt into the future energy mix. So this is how Neo Capital set our strategy to focus on those two industries, which probably account for 40% of Chinese GDP. And answering Hong's question, what is transition investing? I think it is pretty clear for us that all the opportunities we see in those two industries driving the digitalization and the decarbonization transformation of those two industries will naturally fit into the definition of transition investing.
Thank you very much, Maggie. Not only our panelists have shared clear goal in terms of transition investment, Maggie also mentioned their very focused, targeted sector. And that leads to my next question to other panelists as well. So currently, which sector appear most promising, appealing to the transition investing?
Yeah, happy again to go first. I think to think about a question in terms of what's most attractive for investments, one sort of simple way of thinking about it is, what actually drives the investment returns in the longer term? And there are two big drivers really. So we mentioned again, like if transition is shifting from brown to green, a huge part of the growth in revenues or growth opportunities would come from the growth of green markets or green revenues and the underlying technologies that Maggie mentioned that would support these green markets. The other big driver of returns would actually come from a policy perspective. If you have more carbon pricing, carbon trading, carbon taxes, there's a material financial impact on companies' bottom line. So when you think about where those drivers would come, you then think about, okay, what sectors would benefit from those drivers? So one good way to think about it is if transition would happen across all sectors, if within each sector we can identify transition leaders, the companies that are transitioning quicker, they will likely have greater sort of upside longer term. And typically, again, it's the sectors that has the most sort of material emissions. So utilities, energy, real estate, they have been one of the ones that has been transitioning quicker. And then the other way to think about is, to Maggie's point, what are the technologies that would benefit in these areas? So whether it's enabling infrastructure or in some cases, vertically kind of integrated players that actually own the sort of green supply chain, those again are companies that have more comparative advantage as these markets grow.
I'm happy to add some thoughts. So I agree with Alex just laid out that if you just talk about which sectors are most attractive, we perhaps have to start with saying, where is the transition most feasible currently? And that is in certain sectors where the technologies are available at scale and well proven and are economic. And certainly utilities and transportation are at the forefront of that. That's not to say that companies in those sectors don't have enormous financial risks, right? As car companies try to transition to EVs, who the winners are might be very different from who the winners were on the old technologies. But fundamentally, those sectors are ready. To some extent, the real estate sector, you're just looking at application of existing technologies around improving building energy efficiencies and new lighting and so on and so forth. So that's sort of there as well. One other thought I wanted to add is, if you want to see who are winners, ultimately, it doesn't have to be only at these, if I may call it, end user industries. There are many other industries that supply to these sectors and who make products, intermediate products and raw materials that go into these sectors, who may also be big beneficiaries that will have to be focused on.
Yeah, I would second that. In many cases, for example, utility, infra, real estate, it probably will extend to a value chain. Even for EV, as Maggie mentioned, it is a quite extended value chain to support this electric vehicle sector.
Yeah.
And Hideki, do you want to add some compliments to this topic?
Yeah, sure, absolutely. So when we think about the technologies and the industry sectors that are associated with the technologies, and so we see quite different ranges of sort of opportunities. But like Alex mentioned, so there's that transition risk, the carbon pricing, and so from the risk aspect as well. So we tend to look at is the technology going to provide the company substantial contribution to its own GHG emissions reductions, or is the technology going to help the company's customers achieve substantial GHG emissions reductions? So that's the sort of the scope 3 side. So there's that footprint as well as the sort of the handprint of the greenhouse gas emissions. That's how we kind of look at the sectors. And in terms of the sort of the specific sectors, I think Swami mentioned about the clean energy supply chain. And absolutely, I think that's what the market is looking at as well. So the battery metal productions to equipment factories and so forth. So I think the investment in that space last year was pretty significant and sizable, as well as something like power grid and also energy storage investments. So those are also have become very popular in the market. So in the nutshell, the market seems to think that the transition metal, power grid, and storage, those areas are pretty attractive.
And as a follow-up question to the sector attractiveness, so what specific criteria are used to assess the transition investment potential? Maybe start from Hideki as a follow-up.
Yep. So I just mentioned the scope 1+2 emissions from the issuer's own operations, as opposed to the scope 3, which is the downstream, more on the products and services side. So in that case, in terms of the criteria we use is reduction targets, GHG reduction targets, as well as the CapEx plans to be able to gauge companies' commitments and also sense of urgency. And then we look at the carbon emission reduction performance to be able to assess track records. And then the last one is we look at the management quality to understand whether they have what it takes to execute on the plans. So those are the criteria that we typically use.
Thank you. And Alex, anything to add from your organization perspective?
Yeah, no, I think very much aligned with what Hideki mentioned. So Invesco uses the net zero investment framework. A lot of it is forward-looking metrics that Hideki mentioned. So whether it is, do you have internationally aligned disclosures as a proxy for how serious the company is taking some of these initiatives, longer-term targets, green revenue and green CapEx, and also I think more thinking not just the historical emissions reduction, but what's the expected emissions reduction given some of these initiatives that the companies are doing. Hideki also mentioned about quality of management. So typically we find that boards that have compensation and KPIs aligned to some of these climate targets, there's a sort of more incentive to drive for these transition earlier. Final thing I also mentioned from a financial perspective, really evaluating, does a company have sufficient cash flow to actually fund some of these green CapEx? What's the return on that investment? That's also important overall.
So the economics is also one of the major consideration. And Swami?
I just want to add one angle to, to the extent you're looking at a specific bond offering, for example, that is used to finance a particular project. And what we offer as part of our second party opinion, it consists of broadly two components. The first component is something everyone understands, whether it complies with certain taxonomies or certain frameworks that are existing out there. But the second part is what we call contribution to sustainability. And what that does is it looks at the proposed investments from a particular bond, and it looks at the relevance of those investments given the business model of the company and the issuer. And it also looks at the magnitude of the impact that those particular investments can have in the context of the company's business. So while Moody's is not an investor, we don't make investment decisions. I think we strive to provide a degree of transparency to the market about how much a particular investment can contribute to sustainability through that component of our score.
Mm. So we talk about the objective, the act, the criteria. Let's talk about the challenge a little bit. So what are the most significant obstacles encountered when you incorporate the transition investing into your investment strategy?
I think probably I can go.
Sorry, go ahead, Maggie.
I can go first. And as a private equity investors, I mainly see there are two challenges. First of all, we do a lot of venture investments, which means the companies we deal with, they are startups or SMEs. So right now we do want to call for more resources opening up for SMEs, because we talk about carbon trading, talk about those ratings, and provide more transparency to the public. However, if you look at startups business, we see a lot of cases. You can very easily identify how they're contributing to the green transition. However, there is not a standard that can be suitable for their business. And also, when you're trying to get certain resources, you will find that, for example, certain scale of the company and the historical measurement are required. However, those I would say is not applicable to a lot of startups. So I think this is one challenge I do see on the market. So the other one is, I would say, is various financing channels. For example, we are private equity investors. So in addition to contribute to the green future, we also have our own requirements regarding the financial returns. So in lots of projects we encountered, I think they're very interesting technologies, are very good project. However, they may not be suitable for private equity investors. So therefore, we do want to call for various financing products, for example, debt, loans, credit, or even infra fund, to come together to support the whole ecosystem to develop.
And Maggie, when you try to combine different type of solution, before Hideki jumping with more challenges. Now, when you do this combining different type of tools to make a deal happen, is there any major consideration or concern from different tool provider? They feel like we're reluctant to invest in this area, and what could be their major consideration?
I would not say it's reluctancy. I think the intention is definitely higher and higher. However, for a lot of financial institutions, it's very large institutions. So only having the concept is not enough. They would like to present the data. And what is the definition of, for example, climate tech, transition investing? I think the definition is still growing. So every financial institution will have their own, definition. So what we are doing is really to, based on our understanding of those startups, we are building kind of framework to teach them how to speak with this ecosystem, how to speak with those ESG standards. And I think this is work Neo Capital is very proud of. However, we also do want to other partners in the ecosystem to be more flexible. For example, if you do require, for example, 3 or 5 year data out of a startup, I think I would say it will be very, very difficult for certain kind of technologies. It do need a process to grow to the scale.
Thank you. And Hideki.
Yeah, thank you. So the challenge is, I was thinking that it's such a complex issue, and yet investors or company could be perceived as greenwashing very easily. So So there were a lot of movements around this challenges, such as the taxonomy developments, guidelines, and so forth. But market standardization that harnesses local context is also a challenge. So this is sort of a very challenging sort of issue when it comes to like transition financing. And then another thing that I think is very challenging at the moment is the potential for carbon lock-in. So when we look at the transition investment, and is this investment in supporting a particular infrastructure, for example, going to contribute to a carbon lock-in? How long is the infrastructure going to last? And when you think about most of the infrastructures and equipment, they last more than 15 years. So looking at the life cycle emissions carefully, and that's sort of a challenge. And then at the same time, the companies, like Maggie just mentioned, in terms of asking certain data for a startup is a challenge. And in the public markets as well, still disclosure, transparency, and all those things, it's still a challenge. So these issues are all sort of contributing to the overall challenges that we face.
Hideki, as a follow-up to what you just mentioned, what significance do the improved data and disclosure holding in the assessing the transition risks and identifying potential opportunities?
Yeah, significant. I think data availability is really sort of paramount to what we do as analysts, and then looking at the transition investment opportunities. So for debt instruments, so transition bonds, for example, the use of proceeds report is absolutely necessary, and we encourage issuers to issue use of proceeds reports so that we can actually see the commitments that they made is reported, and then the progress is actually tracked sort of in a quantitative manner.
That's very helpful. Now, do you think the regulatory changes could potentially influence the transition investing? You know, we mentioned a few challenges, and this may not be just resolved by single organization. Can regulatory changes help in that regards?
Hon, should I take this one also, or?
Yes, go ahead. And other panelists, feel free to jump on.
Yep, absolutely. So I think we definitely would like the regulators to be helping us, both the issuers and then also the investors. So Hong Kong specifically, for example, so the real estate, energy efficiency related taxonomies to green transport, waste reductions, and those things are highly relevant. And then I think the regulators sort of guidance would be very helpful, and because that actually sets the standards and expected practices for investors and the companies. So I think regulator action is definitely needed.
I would see regulatory action as falling in one of two types. One is creating disclosure requirements, creating new taxonomies and standards, and defining transition bonds. That's one type of regulatory activity that is useful and that can be supportive of market evolution. And then the other type of regulatory activity, of course, is the more broader, actually setting emissions policies or supporting technologies that are needed to actually enhance the transition, such as supporting for hydrogen and so new technology. So it's actually policies, if you will, in some sense, and regulations that actually push the whole transition forward. In my mind, I would say the latter perhaps are more important than the former. The former can help grease the wheels in some sense, but the latter is what really helped move the whole transition forward. Those would be very useful. And I think what in that context, what investors would benefit from is a perspective that is holistic, and it's based on the entire company, and an analysis that really shows whether a company can transition its business the way it is wanting to, in a way that preserves its profitability, hopefully, if not enhance it, or if it weakens it, to what extent could it negatively impact profitability? So an assessment that is focused on the whole entity, and that's really what we are hoping to provide, again, as a way to smoothen or grow the market in a more easy manner.
Thank you. Alex, do you have anything to add?
Yeah, no, I think Swami put it very well in terms of the range of regulations that are required. So at the company level, I think what Swami mentioned, when you have disclosures, the hope is that the companies don't just see this as a checklist or reporting exercise, but use those frameworks to then think more holistically from a company perspective. What are the opportunities and risks to business? How can it become more of a tool for helping with business strategy? And then more broadly from a whole economy point of view, I think Swami is spot on that investors often look to these as ways to analyze risk and opportunity. So for example, whether a certain region has carbon pricing and transparency of how prices would change. So think about a place like Singapore, where you have high visibility on how carbon pricing would change. From an investor's perspective, it's good input into knowing how sectors will be affected. But more broadly as well, I think we often talk about transition investing. What's most important is, what are we actually transitioning into? If a certain region government has a clear pathway of, these are technologies that they're hoping to promote, these are sectors that they're hoping to support, it also helps investors to know where investment opportunities are. So if you think about in the space of climate adaptation, many countries are now defining national adaptation plans. And it's, again, not just a plan to help countries think about managing physical risk, but it's also more broadly thinking about how do this physical risk affect GDP and economic growth? Hence, what are we doing about it? So not seeing, again, climate as a separate thing, but really seeing it more broadly as a policy that affects economic and social goals.
Thank you. Let's share some inspiring success. So could you share an instance of a successful transition investment and the factors contributing to the success?
Sure.
Swami, you want to start?
Yeah, maybe I'll start with one more detailed example, but more conceptually, what could be seen as success stories. We have seen companies that have looked at where industries are going and successfully positioned themselves in their own entire transformative business model to get there. And so we have seen utilities in Europe, for example, really move towards renewable energy in its entirety. Or you're seeing refiners, in some extent, have huge biorefinery operations come into play, and so on. But as something that's perhaps more interesting to this audience in terms of specific transactions and how to work the capital markets, there's one example that we have, which is actually the very first net zero assessment that Moody's published. It was for an Italian gas pipeline company called Snam. And as you can imagine, their company's entire value chain is a fossil value chain. They transport natural gas. That is their business, right? But the company has talked about for quite some time plans about how they would like to transition eventually to net zero, both in terms of Scope 1 and Scope 2 in their own operations, and also in terms of how they would work to set up policies to enhance a hydrogen grid and move towards a hydrogen grid in terms of what they transport, or a mix of biogas and hydrogen grid, and so on. And they found that they had difficulty because I think the market was just seeing them as a gas pipeline company. It's not really a transition story. It's hard for us to see how that could be. So we published a net zero assessment on them. It was an average score, a 3 on a 5-point scale. But what it did do is that the scores come with a detailed report, actually, which is really the value as we see it to investors, it really explained how we see the transition, to what extent the transition could happen, and what are the key steps that the company is taking, and why we think some of those steps are likely to happen, others perhaps less likely to happen. That sort of a deeper dive into one company's business and analysis provided a lot of investors the comfort, and the company was able to do a sustainability-linked bond earlier this year in February. So I think the value of transparency and the value of sort of a holistic, in-depth analysis of a company, considering its business model, that has its value. SNAM is not going to overnight become a full renewable energy player. That's not even what they're talking about, but they laid out a strategy to transition over a period of time, and that transparency can be useful. So we can have capital market tools like this that can be useful to investors and companies alike.
Yeah. So this is a good example of asset owner for a consistent strategy over time with holistic model to deliver. And Maggie, from the two very focused sectors, could you pick a successful example and share with us?
Sure. I really like the story Swami shared and how it is transformed step by step towards the green future. And I would like to share one example from our portfolio company, which is called Alpha ESS. ESS means energy storage system. So this company basically designs and manufactures energy storage system. Is something like the Tesla Powerwall, and over 70% of its revenue is generated from the overseas market, including Australia, Europe, Africa, actually over 90 countries. And how the energy storage system works is together with your rooftop solar PV, your house can be energy independent because the rooftop solar PV generate electricity during the daytime, you store it in energy storage system and use it in the evening. And even more, this company has already commanded market share #1 in Australia. And based on the large volume of the system it has deployed in the local market, it can dispatch the energy and electricity stored in the system and trade with the local grid. We call it virtual power plants. So I think the beauty of this deal is in several ways. First of all, in terms of the climate impact, think of energy storage. It actually increase the usage of solar panel. Otherwise, if you cannot store the electricity generated by the solar panel, a lot of those energy will be wasted. And next, it play a very critical role in helping the local grid to do peak shaving. And this is exactly the direction we think the grid should transform into to adapt to the future energy mix, in which those kind of flexibility is very much needed because of the intermittent nature of the new energy format. And thirdly, I think Alpha ESS very smartly leverage Chinese local manufacturing and supply chain to provide the most value for money products to the global market. For example, Tesla Powerwall is definitely a very big player in this space and has very good brand. But how Alpha ESS can actually command the market share #1 in Australia is because China has the best base for manufacturing and supply chain. So its products has a lower cost while it can also deliver very high quality. And last but not least, when we invest in Alpha ESS back in 3 years ago, the company's revenue was around up to 400 million RMB. And right now, its revenue is 3 billion RMB. Therefore, with the growth of this company, it is also a very good deal in terms of financial return and bring very good result for investors like us.
Yeah. So you really orchestrate all the angles as a leverage to provide help to your investee company. And that just leads to my follow-up question. So can you speak to the importance of a financial investor engagement in promoting the transition agenda within the investee company?
Sure. I think I can explain in several ways. First of all, I will say commercial success is very, very important. Even you have a very cool technology, it is important to scale it up so that more and more people can adopt it. Otherwise, it's just a small cool technology sitting in a lab. This is not enough impact to the whole system. And in that case, I would like also to say that how a good product come together is because it provided better user experience. It is very rarely that people adopt a new product just because it's greener. So I would say EV is the best example to illustrate this point. Why China has such a high penetration rate of EV is because EV is simply much more intelligent than traditional ICE cars, rather than it is greener. So I think private equity really plays a role to put all those elements together and to form a better product and help it grow in scalability, help the technology to develop to mass commercialization. I think this is a very important role for private equity firms. And another perspective is that when we invest in these companies, we will help it to form the we call ESG framework. So that echoing the transparency Swami just mentioned, so that I can talk with the global ecosystem. For example, Alpha ESS, when we invested, it is still a small company, but with the growth of the business, we more and more find this company, if you would like to enter deep into the European market, a lot of measurement, a lot of data is required. So based on its scale and its business back then, it's very hard to find third-party consultant to build such a framework for Alpha ESS. So we step in as the expert. For example, if you ask Alpha ES how many carbon emission you produce, or how many carbon emission you help reduce, at the very beginning they actually don't know how to answer it. However, we calculate it based a lot of operation data. For example, how much electricity you used and how much electricity generated by the solar panel you facilitate every year. Those are the data the companies can understand, and with those data and plus our understanding of the green, the ESG ecosystem, we help Alpha ESS to form the language to speak with the global community. So I think those are the roles that a private equity investor can play in a company, so that to attract more resources to it.
That's really inspiring. So that means generating from the success story you and Swami just mentioned, transition investing not only can have positive impact on the climate, and meanwhile can also make good financial return from this investment activities. So my next question will be, everyone talk about technological innovation. What do you foresee the technological innovation will play? What kind of role in the future transition investing? Hideki?
Yep, sure. So I think technology is absolutely sort of paramount to transition and climate financing so far, and then I think it would continue to be that way. And Alex mentioned adaptation earlier, and I do think that currently most of us are sort of focused on mitigation, but we will see more on the adaptation side of financing or investing as well. And especially for those of us like sort of in Asia, and in adaptation is probably more pronounced than other places. And then also we will most likely see more government actions in the form of transition financing. And some of the governments are a lot more sort of advanced or forward thinking, and then they are already financing transition. But I think more governments in Southeast Asia and so forth will be coming out with the transition financing vehicles as well. And then I think there will be sort of changes to the regulations as well, and then this area is sort of continuing to evolve. And then it seems for the sustainable finance space, the public markets always sort of gets the first attention, equities and fixed income, and then after that, probably private side as well. So in the regulation side, I would think that a lot more sort of guidances to policies and then also government financing. So those things will be more coming in the next 5 years.
Thank you, Hideki. Swami, any inputs?
I think if I were to focus on technological innovation and where it can play a role, I think clearly, there are 2 or 3 technologies that have been identified as key to be a successful transition, whether that's hydrogen or biofuels, carbon capture, and so on. And I think there are innovation certainly in these 3 areas are sort of very critical to the overall progress. But I would also say that if you look at the climate scenarios, and especially such as the ones put out by the IEA, their last report was in October of 2023. If you compare that with the report that was out on October 2022, and if you look at their scenarios as to which technologies will contribute how much in order to reach net zero, in the October 2022 report, 50% of the emission reductions required by 2050 had to come from technologies that were not proven or commercial. By October 2023, that number had fallen by a third. It was now only 33% needs to come from unproven technologies. And what they basically said is that the proven existing technologies, renewables and electric vehicles and scalable nuclear power and so on, they saw that, and energy efficiency, of course, they saw that a much greater room for them to contribute. To me, that is innovation in a way, because these technologies keep getting better. Their potential for decarbonization keeps growing stronger. And I think that's in a way, I would see that as a very positive story that, that they can make existing proven commercially viable technologies can make such a difference.
Thank you, Swami. Alex, do you have anything to add?
Yeah, I think to Swami's point, we should really start thinking about the markets first and then how technology fits into that puzzle. So Swami again mentioned earlier, when you assess a company on transition, a lot of it is really seeing transition plan as a story for what is this company's longer term business model. If I'm, for example, a real estate company and my long-term business model is in net zero buildings, providing net zero buildings, then we think about what technologies fit into that story, whether it's energy efficiency, new building materials. Similarly, if I'm an energy company, my biggest value today would likely be my distribution channels, and using new technologies, whether it's renewable, sustainable aviation fuel, that then fits into my bigger narrative of what kind of company we're trying to become longer term. So again, really thinking more about the markets, the business model, and how technology then fits into that piece of the puzzle.
Thank you. Antoine, any interesting questions from the audience department?
Yes, absolutely. We have actually quite a few questions. So let me try and do my best to steer them in the right direction. Actually, I think the first question maybe, as we've mentioned things about the data challenges, it actually goes to Maggie. And it says, since SMEs might not have that historical or as comprehensive ESG data that bigger companies may have, how does Neo Capital make investment decisions? How can we better engage SMEs in transition investments?
Sure, happy to answer that. This is a great question, and I think similar to venture investing, we, for example, echoing the last question about technology innovations. Our job every day is to identify the key technology and think of how we can help them to get into mass commercialization. So it is similar to, the question regarding green track record of SMEs. You don't see track record, but for private equity investors, especially venture investors, I think this is our job to identify the merits of those technology and bring up certain resources. For example, when you look at technology innovations, for it to grow into a commercialized business, you may need to bring the right talents, the right team, the alpha customers who has the guts to bring down new technologies. So I think with more and more experience and track record deals done in our areas, we definitely have a network that we can have access to all those resources. And so this is one thing. And on the other thing, I think rather than simply thinking of, I would like to find something with all the elements existing here, I think a more proactive way to think of I see this a very good seed of technology or seed of business. How can I really give it watering it to help it to grow? So I think this is more exciting in our job. As the example I mentioned, looking at those companies, and we're continuously thinking of how to help them grow in scale to achieve commercial success and to speak the language of a more global community. So I think this is the job of a venture investor like us.
Thank you for promoting the VCPE industry. I think you're giving it a good name. We have a few questions here. I think there's quite a lot of interest in terms of approaches to investing and looking at opportunities. So it's two specific questions for Alex and Hideki. What is the usual time frame that you set for tracking investee companies' transition performance? Any escalation steps if no meaningful improvement seen? And also, and maybe a more broader question is, do you use qualitative approaches to assess companies' transition performance on a case-by-case basis, or do you have systematic quantitative ways to assess your portfolios? So that Alex or Hideki?
Yeah, happy to give it a Hideki, feel free to add on as well. I think in terms of timeframes, what's probably most practical, I think it's that by two aspects. As asset managers, we sit in the middle between asset owners who are our clients and also issuers and companies that we invest in. What you notice is these two stakeholders do have targets of their own. A lot of it is 2025 or in some cases 2030 targets that they're working towards. And those become helpful in sort of time horizons that we would work towards as a sort of investor. So a lot of times when we think about engagements, it's based on those targets, what needs to be done in the interim time between now and then, how does it then affect the company's financials and bottom line? So that's one piece of it. The other question I think is, again, a very sort of real practical question, and there's no single right answers right now. But typically what you would find is that most investors, ourselves included, we would have some sort of standard framework that we use to assess companies on. So we mentioned net zero investment framework, for example. It looks at targets, disclosures, CapEx, green revenues. Those become standard parameters that we evaluate companies on. But a lot of the assessment also comes in addition to just what the data is showing. It comes from engagements with the company, knowing kind of how they're thinking about some of these issues, also knowing how the company is set up internally. So for example, you mentioned the governance setup. Do they have board oversight on some of these matters? Those are all sort of softer proxies into how serious a company is in thinking about some of these longer term plans. So it's again often a mix of both standardized kind of metrics, but then also complementing it with the engagements to feed into the investment process.
Yep. Yeah. Thanks, Alex. Yeah. So if I were to add, so if we were looking at the transition bonds specifically, and then it has a maturity, then the companies ought to be articulating what type of goals that they have and milestones and what they want to achieve. So we expect the companies to, again, issue use of proceeds reports to articulate and then to showcase and to basically evidence the performance of the financing. So if the company does not issue use of proceeds report as of now, then yes, that would become sort of an engagement candidate. And then if they I think knowing the progress, whether the company is planning on issuing use of proceeds reports, and it's just that at the time they are not able to do so for such and such reasons. So sometimes we just kind of want to understand what the obstacles are. So that would become sort of an engagement sort of candidate. And then in terms of the systematic versus sort of qualitative, a lot of times it's very difficult to compare one company's goal against another company because a lot of times the business models, the business segments, geographies that they operate in, those are all different. So sometimes it's a sort of a more qualitative, but using the quantitative data that's disclosed by the companies to be able to kind of assess companies' progress and then also the potential for greenhouse gas emissions reductions and so forth. So it's kind of mixtures of both.
Great, thanks.
Anton,
Sorry, after you.
sure. Thank you for the very good question from the audience. Now, with limited time remaining, I would like to ask the panelists, each of you, what are your views for the future of transition finance in the next 5 years? 1 to 2 sentences for each. Starting from Maggie.
I think I'm very glad to see that the intention from all the stakeholders within the ecosystem is the highest ever since. So I would say there will for sure will be some great milestone achieved in the near future. For example, the standard of the green financing and more applicable measurements suitable for different kinds of companies, different regions. I envision this is to happen going forward. And also on the other side, I think the awareness and the scale of transition investing, we already see it is growing very fast, but I do believe it, even though it is still not a big part of the whole investment world. So I do believe it will continue to grow and to become a really the mainstream of the whole investment world.
Thank you, Maggie. Alex?
Yeah, maybe like building off what Maggie said in terms of growth scale, 2 points to make. One is that transition investing today will likely become more mature as a market, very much similar to the trajectory that green bonds went through in the past. So more standardized standards, more issuance and uptakes. But we'll also mention that typically the greatest returns always come in the early stage of growth. So that's something to keep in mind as well. The second area we would point out is a lot of it, we will see more innovation in financing. And Maggie mentioned some of these earlier, but whether it's blended finance, impact investing, there will be more forms of capital to support this industry as a whole. And that will be something exciting to watch as well.
Bobby?
So transition finance is a key strategic priority for Moody's. As we see this, the volume of debt supporting the transition doubles, triples over the next decade. What we want is to provide the kind of opinions that investors find valuable. And if I can refer back to something Hideki just said, we think the greatest value is to provide on a common comparable scale to make companies comparable using a holistic analysis of both the ambition of a company's targets as well as their ability to achieve them. And to make that comparable is really what would unlock potential because it makes investors' jobs a lot more easier.
Thank you. Hideki?
Yeah, thank you. So I think I just sort of echo all the other panelists' points. So I think the transition financing space will continue to grow and then also mature, at the same time evolve and then have different products. And when you look at the green bonds and the success of that was when you look at the levelized cost of energy for renewable, that has come down significantly in the past 10 to 15 years. And that was much faster than what people predicted. So I would expect that a lot of the technologies, like in terms of the energy storage to power grid and so forth, and I would think that we would expect a lot of success from those. And in the next 5 years, I think this transition financing space will sort of more mature than the current state.
Thank you to our panelists and attendees. Your engagements and insights really enriched our discussion, and it really reflects a shared commitment to the whole community to drive the meaningful change. With that, I will hand back to Cun. Cun, thank you very much.
Thank you, Hong. Thank you, Alex, Hideki, Maggie, and Swami. That was a really great session, and we covered a lot of important topics, starting from the challenges of defining what transition means to accessing data, which again seems to be a constant thorn in the side of progress. But also, it was great to hear about the successful investments, and of course, we all got a better sense of how managers are approaching their investments. So I certainly feel better informed than an hour ago. If you missed anything or would like to rewatch the webinar, recording will be available on our YouTube page in due course. Once again, for those seeking to claim SFC CPT points, please complete the survey at the end. And if you enjoyed today's session, please remember to join the Hong Kong Green Finance Association's annual forum on the 9th of October at Hong Kong Convention Center, where we will explore more topics on transition finance from a wide range of experts, policymakers, and seasoned leaders in the finance and banking sectors, including our distinguished panelists today. So once again, thank you all, and please also follow us on our website and social media for more HKGFA events. Thank you and have a great day.
Thank you. Take care.